Welcome, everyone, and thank you so much for joining us today. We're super excited to have you here, and you're in for a really great discussion as we have a fantastic group of leading industry experts, as you can see here, gathered to explore all things opportunity zones, from legal and tax considerations to development, marketing, and much more. My name is Angela Hwang, and I'm the founder and principal consultant at RevGen Consulting. We specialize in helping sponsors raise capital directly from accredited investors through strategic multi-channel marketing and business development initiatives. So I'm super thrilled to be moderating today's timely and insightful webinar. I would like to invite each of our speakers to briefly introduce themselves to get started. So Brett, why don't we get started with you?
Thanks, Angela. Welcome, everybody. Thanks for joining us today. I'm Brett Siglin. I'm a director at Fenimore, and we've been very active in the OZ space since the outset. I've been working on OZs since mid-2018, set up over 150 qualified opportunity funds and qualified opportunities and businesses across the country over the last several years. And we work with a variety of sponsors, developers, investors, and other stakeholders in the industry that are doing all kinds of deals in opportunity zones. So glad to be here.
And I'm Valerie Grundusky. I'm a tax partner at Plant Moran. We're assurance tax wealth management consulting firm. I spend most of my time in real estate, a little bit in wealth management as well, and I co-lead our opportunity zone practice. Similar to Brett, we kind of got in, I'm on the ground floor with this. And so we've been helping clients kind of across the board, from the investors, again, to the fund managers, the developers, the sponsors, everyone, and anyone who has an interest in opportunity zones. We've been doing what we can to help.
Hi, I'm Graham Allison. I'm with Opportunity Zone Development Group. We're fund managers and developers in Columbus, Ohio. Much like my colleagues here, we started our firm in 2018. We work with sponsors, investors, nonprofits, landowners, and business owners in the Opportunity Zone space. We've had a chance to work with about 200 investors in about 30 states to look at a variety of projects and a multitude of verticals, everything from healthcare, which is one of our primary verticals, to housing, to energy, to film, to IT. We've run even a Ferrari museum. So we've as well as a program to help ex-offenders be rehomed into the community. So we worked on a variety of projects and be happy to really talk about some of the tricks of the trade and maybe how to avoid some potholes along the way on the road. Definitely glad to be here. So thank you.
Well, thank you, everyone. So let's start with the big question. This is the questions that we get asked quite a bit, but I want to pose this to all the panelists here. How has the investor sentiment around opportunity zones changed over the last, let's say, 12 to 24 months?
I can kick off. Yeah, I think in the last 8 months, really, we've seen a real uptick in interest ever since the Big Beautiful Bill signed into law last July. I've probably seen triple the amount of activity and interest in the OZ arena. It's about as exciting as it was in 2019 and 2020. I think there's a lot of talk, a lot of interest, and a lot of potential going into the upcoming year. So yeah, I'm really excited about it.
I agree. I think the permanence factor of the OBBBA kind of helped reinvigorate it, largely because I think there were some people who kind of stayed on the sidelines. Like, if this is just going to be some temporary program, they didn't necessarily want to invest too much time and effort and energy into trying to understand it. But now that it is as permanent as anything can be in the tax code, I think we've got a whole new host of people who are interested in exploring what it means now.
Really, we are seeing now a transition with the OBB. We're starting to see investors look at opportunity zone businesses, and that's a big transition. They may have had a chance to look into some real estate or some other of the primary tools that we used, and now we are seeing transition into OZBs. And so I think that's going to be a big thing with a now permanent program that we can create some certainty. So now we know the rules of the road ahead, and that's had a big impact on interest from across the board.
I think that, it seems that there's a lot of excitement with OZs, with its permanence, but do you get the sense that a lot of investors are just waiting until OZ 2.0 happens? What's going on for this year? Do you still feel that there are benefits of investing under OZ 1.0 versus do you recommend that investors wait till OZ 2.0? I think that's the $1 million question, right now. So I'm curious to hear your thoughts.
Well, I think it depends, right? Because it depends on your individual circumstance. Because if you have a gain that is one that it's already been triggered and you don't have the 180-day clock won't take you into 2027, there are still opportunities that exist underneath what we kind of refer to as OZ 1.0. And those census tracts, even if they aren't redesignated in 2.0, those are still eligible for investment through 2028. So we are trying to like help. That's one of the top things I think that we're trying to help people navigate is like the 1.0, the 2.0. Is there a way to bridge the two, especially in that 2-year sweet spot? But it is definitely not a one size fits all opportunity.
I echo that, Valerie. A lot of people out there saying we're in a dead zone. I couldn't disagree more with that, but it absolutely is particular to each investor's situation. Of course, folks that are going to be selling assets now, we would want to get them in a 1.0 deal so that they don't, potentially lose out on getting those benefits. Of course, if they're in a partnership now and they sell, they might be able to get in early next year into 2.0, so that's a huge advantage. But there's also, potentially advantages that we should talk about. If you're in a 1.0 deal, even now, you might be able to, really get some advantages that you won't actually ever get again after the end of this tax year.
We're starting to see some strategies that we can utilize to bridge the two. And there's really no official 1.0, 2.0. We use that language quite a lot. But you can be a capital gains investor now and in the second iteration and go into a 1.0 project. Projects can be reinvigorated with some OZ 2.0 capital in an OZ 1.0 census tract. If you have a gain, from our mind as developers and sponsors, we can bridge a gap between for those that have an LLC gain now. We can take them and then find a strategy, for example, through a convertible note or something that we go into now into an investment so you don't have to wait to move a project forward. You can do that now. And then on 1/1 of next year, you make your declaration that you're going into an opportunity fund at that point. So we are starting to see some strategies that can be very effective to use 1.0 sites with 2.0 benefits.
Graham's point was a good one because we do tend to say 1.0 and 2.0 a lot, which I think can cause some confusion. There is only one type of qualified opportunity fund. There's only one, there's just the rules change for certain things, effective after 1/1/27. But the exact same qualified opportunity fund that exists right now can also exist, for that kind of short window of time in between, and they can take 2.0 investments, however we want to word it. So I apologize because I know I will default to saying it a lot and it probably causes confusion, but Graham was right. They're not really like they're not separate entities or separate vehicles. It's just different rules.
I think that's a really great point because I think there's a lot of confusion for investors. If they have a capital gains event now or they're running out of the 180-day, timeline, can we clarify the current benefits that are covered through the end of December versus if they were to wait till next year? I feel that there's a bit of a confusion on that. So I would love for our speakers to clarify that.
I can touch on that quickly. So, the obvious disadvantage right now is I would only get a deferral until the end of this year if I invested into a QOF, and I wouldn't get any kind of step up in basis at this point. That's long gone, but I would get that, if I waited until January, technically. So the biggest benefit that I'll still get is the exclusion after I hold in a fund for 10 years, and I wouldn't have depreciation or capture either after 10 years. Now, there's another huge benefit that I could potentially get if I'm invested in a fund this year, and especially if it's a deal that's maybe a little further along, a real estate deal that's beyond entitlement into construction, maybe not yet placed in service, but there's potentially benefits under 1.0 that will go away on December 31st, 2026, and that is if the valuation of my interest in that QOF is less than the actual amount of gain that I contributed in, then I can take the lesser amount, the lesser the fair market value of my interest. And we're not seeing probably enough people take advantage of that. And it's really a one-time thing that will probably never happen again in history. And Valerie can talk more about this too. But potentially, arguably, if I'm in a fund and I have lack of marketability, I've got lack of control, I'm in a fund that owns a project that isn't generating revenue, then there's pretty significant valuation discounts that I can potentially take advantage of. Of course, there has to be a third party valuation done, but those benefits could outweigh the step up benefits that I would get, say, in a year in investing in another fund.
So to Brett's point, I would say one of the things that we're hearing the most right now, right? People are reaching out the most. It's everyone freaking out about this gain that's going to come due at the end of the year. Anyone who was already invested in opportunity zones, like, yes, there's a lot of chatter and excitement about OZ 2.0, but anyone who was already, part of the situation at 1.0, there's just a lot of concern about that. And as Brett pointed out, the gain that you're going to pay tax on is based on the lesser of, like the way the regulations are written, it's literally the lesser of, your initial deferred gain that remains or the fair market value of the investment. There is we've talked about this as a group, there's some bad information out there. Like, so if you just kind of depend on AI to look up certain things, you're going to potentially get some bad facts. There is nothing in the OZ legislation that defines fair market value, that puts restrictions on how to calculate fair market value. You would just go to the other places within the code where they determine how fair market value is determined. And that can, on like the real estate side, like you said, Brett, that there are things that when you're doing an appraisal that you can look at different, the stage that a project is in. There are different factors that can kind of contribute to a reduction in that value. And in addition, where it's most popular is in gifting, estate planning type areas. There's always been these discounts that can exist in the valuation side of things as well. And so that is definitely a very hot topic issue with us here at Plant Moran. Like, we're fortunate enough to have some valuation consultants in-house who can help with both sides of that, the appraisal and then also valuing the business itself. And to Brett's point, because there's going to now just kind of be this, like, there won't be this like one size fits all kind of drop dead date. So we are kind of in this weird zone here with OZ 1.0 where there might be some opportunities to see whether or not the deal would be one that you could get that opportunity to pay a lesser gain.
I would want to say, as far as timing, speed to market can mean everything as well, especially for operating businesses. If you're in a project and you are 50% or even through the entitlement stage, to be that much closer to EBITDA, right, or to NOI, depending on what type of business you are in, and then to be able to potentially have a fair market value valuation to provide that reduction in taxes, and then you would also be closer to a potential cash out refinance if you are in a real estate venture within the 2-year time period. That can significantly increase IRR, right, by being able to, and combining that with potential fair market value reduction in taxes, that could have some real punch, coming in midstream on a project. But happy to hear more thoughts, Brett, if you had something to say.
Yeah, no, for sure. Thank you, Graham. And Valerie warned me, we don't want to get too down into the weeds here on examples and numbers, but we're already, this is a hot topic, and I can try to address some of the questions that have come in just in the last minute or two. So hypothetically, let's say I'm an investor and I have an interest in a fund that's, a 1.0 deal, currently maybe in construction, maybe it's, half built, clearly, beyond entitlements, not yet placed in service. There's going to be a valuation of the property, but there's also a valuation of the company. So my interest in the fund is treated differently, right? So I get discounts potentially, and I'm not going to tell you what those are because they're going to vary across the board. But let's just say hypothetically, I get a 20% discount because of my, the lack of marketability of my interests. I can't easily sell my interest to someone else in the market. I don't have a lot of control. The GP or the managing member is basically making decisions, and I'm more or less along for the ride. So I'm going to get some discounts for that. And let's say I put $1 million in of capital gain. I would generally be subject to a capital gains tax at the end of this year, let's say 25% of $1 million. So that'd be a $250,000 obligation. But let's say there's a study that justifies that my interest is worth, say, 20% less than that. So I would be taxed at the lesser of the fair market value of my interest in the fund or that contribution. So I would be taxed on $800,000. That's how this hypothetically plays out. And next year, let's say I invest in a deal and I'm getting 2.0 benefits. I would get a 10% step up in basis, which is really nice. And I would also get a 5-year deferral, which, I'm not getting now. But that's how, this is a little bit of an apples to oranges comparison, but arguably that discount that I could get up until the end of this year is more valuable than that step up in basis that I would get, say, a year from now.
And to Brett's point, it varies. Like we can't give you any sort of like, oh, here's, the numbers that you should expect or what it'll be. It completely depends on the facts and circumstances and what the underlying project is. Like Graham was talking about different things that could apply for operating businesses. A lot of 1.0 was real estate. And so that's why we were talking about construction risk, where maybe things are with lease up. Like I know we have some that we've looked at where what they expected things to look like when they made the investment versus perhaps like what the rental market is in that area aren't the same, right? And so again, just because you put in $1 million into the project doesn't mean that this real estate project is still worth $1 million. There are some caveats that I'll wait till later to get into, Angela, because I don't want to like for everyone, because this doesn't necessarily work without some additional footwork for everyone. So I do just want to remind people of that, but we can chat about that part later.
This may be a good segue into another question that I had, which is what are some differences or some changes in the way that OZ funds are being structured today from both, regulatory, legal, tax and, capital stack and so forth. So I would love to just kind of ask about that, Valerie from a tax and accounting perspective and Brett from legal and Graham from, like the investor alignment and capital stack.
So we're starting to see more creativity in the market and some innovation now. So we've learned the rules of the road. And so, for example, the project behind us, I can give you just an example as a brief case study. This is a project in Ohio, which has its own 10% tax credit, which helps through all of this from a financing standpoint. However, in this particular project, which is in a rural setting, we are developing a surgery center and medical office building and adjacent freestanding emergency department. And that's in conjunction with a group of surgeons. We have 3 opportunity funds for this particular project. We've got a 50-acre site in which we have an opportunity fund to develop the infrastructure. And we've got some revenue coming back on a TIF and a JED to pay for the infrastructure on that site. We have the real estate partnership, which includes the physicians as well as the GC and other developer and our company have come together. And we are in discussion with a couple of hospital systems to create a true joint venture out of this venture, and it's now competitive at this time. In addition, we have a joint venture, and we are the fund managers for the opportunity fund for the surgeons themselves. Now, we're not in the opportunity zone business because we don't have a malpractice insurance as physicians, but we are their fund manager and chief compliance officer for that fund, for that opportunity zone. So we have 3 funds that are operating through one project. And what that is doing in this rural setting is enabling the OZ investors to get into a deal that's far along now in its development, ready to break ground next month. And the opportunity zone businesses will then be able to lease under 2.0. So they're going to have some additional benefits being in that 2.0 when we finish construction next year. Now seeing some real creativity in the structure. And Brett, I'll turn it over to you and Valerie to talk more about what the nuts and bolts are.
Well, we've seen a lot of the same type of structure. It really hasn't changed significantly from 1.0. I mean, you still have, offerings with, a sponsor team. Generally, there's going to be a pref that's offered to the investor. There's generally going to be, some kind of return that's anticipated. And then there's usually some sort of promote structure between, the sponsor and the investors. There might be some hurdles, right? That, maybe if you hit a certain return, the sponsor is going to get, maybe a higher piece on the back end. And generally, that hasn't really changed much over the years. We're seeing more pref equity in deals, especially deals that are further along. And that's been a really creative vehicle for financing OZ deals, especially those that are maybe like deeper into the safe harbor period. So we're seeing a lot more of that in recent months. What we're also seeing is we're seeing a lot of QOFs coming in side by side, sidecar QOFs, folks that have their own funds. Maybe they couldn't find their own deal, or maybe their deal didn't work out as anticipated. So they're finding other sponsors and teams that have their own QOZBs that can bring them in side by side, because we all know you still can't invest in another QLF. So that's a creative way to get around that. And we've seen a lot more of that in the last year or two.
Yeah, I think the points that you make are good ones, Brett, is that there isn't necessarily a ton of things that changed. We had a wish list of things that were out there that we had hoped would be part of this OZ 2.0 legislation, OBBB, which had those things happened, maybe there would be, like you said, the kind of being able to, fund investing in a fund and things like that. If those things had happened, I think there would be a lot more structuring differences compared to what we did the first go around. But the nuts and bolts are still very much the same. And so at least from that perspective, and maybe it's just more that there's just a more educated population of people who are becoming part of it. So they're asking more questions and expecting things to be set up a little bit differently than in 1.0.
I will say we are seeing new investor classes come along as well. So for one of our projects, we created a partnership or joint venture with a group called Building Hope, which is a nonprofit out of Washington, D.C. And they've developed about 300 projects across the country over their history. And so we've created a joint venture to go into OZ development, and we are doing a medical office park with them. But in addition to our OZ investors, we have created a program-related investment as well for the foundation and nonprofit class if they want to also participate in these impact investments. And so there's a different return profile for those investors, but enables them to take advantage of going into areas that need development without getting into UBI conflicts or what have you as part of a nonprofit or a foundation, but to really get behind the mission and be in line with the other private capital. And so we're starting to see new investor classes come along as well.
That's very interesting. I'm also starting to see more first-time OZ sponsors come to the market. I think particularly after OZs became permanent, I've been talking to quite a few first-time sponsors where, we just learned about Opportunity Zone and we want to have our first fund and so forth. Are you guys seeing that as well?
We do see that. So we get approached with we have quite a bit of deal flow. So we've had a chance to find some fantastic projects. But the project over my shoulder here, that simply came from a landowner, and he reached out to us and said, I just bought 50 acres in an Opportunity Zone. What does that mean? And so that was really the beginning of the conversation. And that was about 13 months ago. We went through an RFP process. So there was about 12 different sponsors that pursued this project, and we were able to come out ahead on that one, which is great because we've got some great partners on that. But it was a first-time developer. We came with our team and lent our background to it, and so now we'll get ready to break ground. But it's been we are seeing new ideas in rural areas as well as urban areas both.
In addition to first-time sponsors, Angela, we're seeing a lot of people that maybe were active 4 or 5 years ago that are getting back into it. So that's exciting too. So folks that are rather sophisticated that maybe struggled, right? We all know, capital raising wasn't the easiest thing to do, post mid 2022, and it's probably picked up a lot in the last, 6 to 9 months. So we're starting to see some pretty sophisticated groups that are getting excited again to go out and find new opportunities, new prospects, new sites, and beef up for 2.0.
Actually, I'm really curious with the uptick in new sponsors and also the returning of the sponsors that have been inactive but now want to be active again with OZ 2.0 and the increased reporting requirements. Are there certain things that the fund manager should be doing right now to anticipate and prepare for that scrutiny in the future?
I think 100% yes. Unfortunately, we're still waiting for finalized versions of what everything is going to look like, right? We know that in OB3, it spoke to the fact that they are going to be requiring more information and information directly from the underlying qualified opportunity zone business, which did not happen in 1.0. So absolutely the best that people can understand that and just make sure that either they have the tools themselves to be able to gather that information or to be looking for someone who can help them. Graham was talking about how with some people, they kind of step in as their chief compliance officer, right? Make sure that they're doing the right things, that they're checking the boxes and whatnot. And so I do think that this is going to be a space where that's going to continue to be helpful, is to make sure that if you can't gather the data yourself, that you're finding someone who can help you pull that data together.
And Brett, do you see any ambiguity? Like, are there certain areas, as far as like legal and regulatory areas where there's a lot of ambiguity for investors and sponsors? Are there certain things that they're confused about, or what are some of the misconceptions and so forth?
Thanks, Angela. I'd say the biggest one right now is there's a lot of misconceptions. There's a lot of chatbot chatter out there. Like Valerie said earlier, the statute is clear. There's QOFs, there's QOZBs. They don't segregate between the two. There certainly are different benefits for investors after the end of this tax year. But I think maybe the biggest thing we want to do, get word out there and educate, is that there's actually a 2-year period until the end of 2028 where it's still possible to invest in 1.0 deals, and that might be one of the most exciting times to say, look, we've got some great deals out there. We've got some great sites that are still eligible, and we've got this new crop of investors coming in, and it's still possible to invest in those deals because those zones are going to sunset in less than 3 years from now. And so, arguably, those are some of the most lucrative, attractive, sites out there that, for whatever reason, demographics have changed since 2010, and they may not be eligible in this next round. So,
And Brett, they might have changed because of opportunity zones, right? Maybe opportunity zones brought enough
absolutely.
Yeah.
But I would say that, getting clarity on that from Treasury would be top of my list, just to sort of temper folks that are concerned about that.
I'm curious to see, from your experience, are you seeing investors asking certain questions now that they probably weren't asking maybe 5 years ago, or when opportunity zones were relatively new?
Yeah, no, Angela, I think there's so many people out there that don't understand this, and there's a lot of sophisticated people out there that probably have millions of dollars of capital gains that are just unaware of OZs, or maybe they have a misconception of OZs. I would say top of that list is, folks may still not realize that I don't get the OZ benefits unless I invest capital gain. So unfortunately, that's always been the case, right? But I think that might be the biggest misconception out there. And so that's confusing. Of course, the 10-year hold is daunting for a lot of folks. But I think you would probably know this better than anyone, being where you are, that there's a lot of wealth in Silicon Valley, a lot of people selling stocks that probably have no idea that this incentive even exists, and we'd love to bridge the gap and bring them into this space because there's really no other incentive like it.
Absolutely. Yeah, a lot of my, former colleagues and friends in the area, they have this tremendous stock gain from, selling their company stock shares, and they just end up paying capital gains tax. And when I mention OZs, it's like, well, what? What is this? So it's really interesting. I think that there's a huge potential for sponsors to tap into that investor pool. And I think there's just a lot of educations that, that we have to continue to do. So a couple of questions came up that I want to address. So Sean's asking, any sense of whether there will be a safe harbor of some sort for investment in 1.0 sites? So if a 3-year development project starts in 2028, can it still be an OZ deal in 2029 and 2030?
So Sean, based on, what we have right now to go off of is exactly what is in the code and regulations already. And so because those zones expire at the end of 2028, investing into a project that is nowhere near completion at the end of 2028 is probably not going to work out very well, because you need to be like, that opportunity zone business needs to meet its tests, right, to be qualified as an opportunity zone business. And while we expect that the zones, once projects are kind of up and complete, we expect that those zones will be respected. Otherwise, OZ 1.0 wouldn't have allowed people to push out their exit until 2047, right? It's not written anywhere for sure that that's the case, but we're expecting that it will come out that way. The problem is that like the opportunity zone business has to look at its assets to see what qualifies and what doesn't. And so if any additions that they're, work that they're doing on those projects after 2028 are considered bad assets or non-qualified, our concern would be that, that would essentially cause it to be a bad QOZB and therefore a bad investment for the Qualified Opportunity Fund. And so maybe, hopefully, we could get some guidance along the lines of what you're looking for, Sean, between, now and, I don't know, the next year or so, to allow people to do that. But I think on the front end, we're okay. But I think, towards the back end, it would have to be a deal you'd have to be investing into a qualified opportunity zone business project that was already pretty much close to completion.
But I would say actually I differ with that. Even if we don't have guidance, I think the working capital safe harbor still lives on. So, arguably you would have
Sure.
that 1 month period, through the end of 2028 into maybe 2032, and arguably you might even have an extension of up to 62 months if you raise equity beyond that. So I think the safe harbors that we have already and that we've had since 2020 will apply in the same way to all QOFs and all QOZBs. It just, it's going to be more confusing for sure after 2028. But I think if the deal is started, you're raising money, you've kind of got your stake in the ground before the zones expire. I think there's probably going to be pretty good case to argue that it's still a good QOZB.
And that's fair, Brett, because there obviously was kind of a carve out, like a safe harbor for self-constructed property in the regulations as they state currently as well. So
Kevin's asking if the OZ areas that totaled more than 8,700, so OZ tracks back in 2018, has that changed? Have some of those tracks been lost, or more or less number of locations, and what that looks like for OZ 2.0?
it's this summer, right? That designation process is happening. But what we do know already, based on the current map of eligible investments, because there are a lot more restrictions on what can qualify as a zone this time than last time. And I believe the math that I saw is, whereas the total possible last go around was 8,700, I want to say that number is now 6,500 maybe, is like the total maximum based on the way the rules are written currently. And I'm sure Brett or Graham might have some opinions.
Echo that. I think it's fair to assume there's going to be 20 to 30% fewer zones at the end of the year in the 2.0 designation. And you also have to keep in mind that each state is supposed to be designating 25% of those in rural zones. Now, there were a lot of rural zones in 1.0 already, but like Valerie said, there's more restrictions on what can even be eligible. So the maps are going to change a decent amount.
And with the AMI, we should probably dig a bit into that. So these zones will not be as far along in the development stage of many of these, right? And so with the AMI or the median income decreasing from 80 to 70%. Hence the added benefits with the step up in basis and such to help with that. But they will be further along the OZ 1.0 tracks. So that could be another reason to get in this current 2-year window into a 1.0 site.
So I'm curious, earlier we talked about aligning OZ incentives, with investors and so forth. So this is a question for you, Graham. I think from a development standpoint, I'm just kind of curious to see if you think there are certain lessons that we've learned over the past, 5-6 years as far as aligning OZ incentives with realistic project timelines and community outcomes.
Yeah, so our background is originally in economic development, and so you talked about incentives. So one of the biggest lesson learned is don't go it alone, right? So create public-private partnership. Work with your economic development professionals in your community to obtain resources. For example, the project above my shoulder, we're working with new market tax credits, and we have infrastructure grant funding, and there's abatements, and there's tax increment financing, and there's joint economic development districts. So just finding a very creative mix and trying to find all the resources is very important, so that you can mitigate the risk of going into these areas that are going to have been challenged economically. I can tell you that the project here in Great Seal and Chillicothe, it's part of what we've talked about as a rural mural. So you create one of these, but you use it to create a snowball effect, and this project is going to lead to a hotel. So we based on this project, we have a LOI with the region's largest Hilton provider, because he heard we were here going in this project, and he wanted to attach to that project because of the market that's been created. And out of that, there's a restaurateur that wants to go next door. And then, ultimately, we're looking at some assisted affordable housing on the back end of this 50-acre property. But all of this was triggered because of the opportunity zone legislation. And then the other incentives that make this, feasible. It can stand on the OZs, but to really make it very attractive, getting additional incentives is very important.
So speaking of incentives, are there certain additional incentives that some sponsors may not be tapping into? I know certain states offer additional tax benefits, and things like that. So I'm kind of curious, because I know you specialize in capital stacking. Like, I'm just kind of curious to see what are
Oh,
some
gosh.
incentives out there.
Yeah, as well. So we got some experts on the paddle. Things like new market tax credits, EB5. You talk about a pref equity, Brett. So EB5 can be treated a bit like pref equity in there, and it can be paired with pref equity. Lending programs, working with the CDEs, working with your development agencies to assist with lending programs. There could be grant money for infrastructure. There could be some other loan programs for an OZB that is going. Maybe it's the SBA that assists in developing in an opportunity zone, the USDA rural development. So we've had a chance to work with about 150 incentives. So I won't bore with the entire list, but really get a pro, find somebody that can help you to find those, whether it's your, attorney or accountant or an economic development consultant.
Another option that is available in certain states is there might be property tax exemption, especially if you've got a tax exempt entity or a nonprofit in the structure, or some other instrumentality of the government, or a housing authority or something like that. There's a lot of property tax exemption opportunities across the states.
So there is that safe harbor that existed in the final regulations, the first go around. It's basically if 10% of the, what I'll kind of call the hard costs, are incurred by the end of 2028, 10% of what you expect the total project budget to be, then Sean, then you can potentially be in a situation where you get, like Brett was expressing, those traditional periods to complete the deal.
Well, the good news is, sponsors still have time to get their deals together. I mean, we still have almost 3 years, but certainly you want to have some sort of stake in the ground, some sort of beginning before those tracks expire, and then you can still get your deals done.
Let's talk about that. What should the sponsors and developers be doing right now to prepare for OZ 2.0 and so forth?
Number one right now at this particular time is lobby, because the time is now to try and get designated, right? We know what tracks are eligible, but that doesn't mean they're going to be designated. A lot of those eligible tracks won't be designated. So, for the next 3 to 6 months, 4 to 7 months, this is the best time to get out there and meet with folks at a local or state level, and really try to make a case for why you think certain areas should be designated.
If you're a landowner in a zone that's eligible, it's definitely a good time to make a call. The third quarter is coming quick.
Of course, it's a great time to get out there and just make noise about your deal, and do road shows, get people excited, even though maybe their gains, maybe it's premature now to invest in it. It is premature now, but maybe somebody that has a gain coming up in a few months could be eligible to invest in your fund starting in January 2027. So it's not too early now to get out there and get those commitments.
Absolutely. Actually, Brett, if I may add, that's what I advise sponsors as well, because I think certain sponsors feel that, we're just going to hold off on promoting ourselves, building our brand or marketing our deals until January. And I say, well, if you want to stay competitive and stay ahead of the curve, this is the time. This is the best time for you to do, for you to educate people about opportunity zone investing. This is the time to build a brand so that when investors are ready to deploy their capital, you'll be the first one that they think about. So absolutely, this is really that preparation time that's really important. Valerie, any additional thoughts?
I can circle back to the one comment that I had made earlier when we were talking about valuations, which can be a very exciting topic. But what I just wanted to caution people on is that the regulations have this thing, it's called the special amount includable rule, which can make achieving the benefit that we're discussing with that fair market value being lower a little bit more difficult, not impossible, but it could be more difficult if you had liabilities allocated to you and you've either taken debt finance distributions or you've had losses allocated to you. Like, now is the time to be reaching out to your tax advisor or some sort of consultant to try to help you restructure that in a way so that you can achieve this fair market value benefit that we're talking about. I just wanted to make sure we brought that up before anyone gets too excited about it and goes down the road and finds out that the answer might not be what they were hoping for.
We're an investor in a publicly traded opportunity zone. The symbol is OZ. It's one of the few publicly traded ones that has got a market value maybe 52 with a audited NAV of the partnership of around 97. It's been a struggling thing with no revenue, et cetera. So am I correct in understanding that when we have to settle up with the original capital gain deferral this year, that we won't need a third-party assessment if we sell that position at 52 or just take that market price? So the client would basically settle up at, say, 52 cents on the dollar for the capital gain catch up. Am I understanding this correctly?
Well, when we were suggesting, right, that if you're taking this fair market value approach and doing valuations and, discounts, we were suggesting having an appraisal and whatnot. But in your situation, when you have something that's publicly traded, like the value is, the trading value went out. It's something that's out there that you can utilize.
Okay. So in this particular case, just as a quick follow-up, we wouldn't have to sell the actual position. We could just point to a market closing price and still stay if we still had the confidence that they ultimately will start generating revenue and be successful. So we could still get the benefit of staying in the deal without, et cetera. So that sounds like
I think, Brett, you don't have any hesitations on that, do you?
No, I mean, I think it's unique that it's public. I haven't personally worked with a public QOF, but I think you're right, Valerie. I mean, there's plenty of evidence out there, right? What the valuation is. I think it's generally strongly advisable that you do obtain a third-party valuation if you're the fund sponsor. But maybe in this case, I think that's right.
Okay, thank you very much.
And Kevin, I would just say, take a look at like your K1s, see whether or not you've had like significant debt allocated to you or anything like that. Because like I said, that could cause some changes to your calculation. So
Great. Thank you. Appreciate that.
Thank you for this. You touched on a couple things about the rules, eligibility, and the designated areas. I own and have development rights for several properties that are currently in designated tracts under one. Is there risk that the designated tracts will change and those could be excluded in the new 2.0? Or is it they're looking at expansion only with new tracts?
No, Matt, there's real risk that a lot of the existing tracts will expire. And not only risk, a lot of them will expire. I don't know where now, do you have QOFs or QOZBs set up, or you just own land that happens to be in a current designated tract?
I'm actually a developer in downtown Phoenix, and
right.
Ended up at all of my properties that I already owned landed in all of these designated tracts. Some of the projects I develop are not eligible because it's for sale development, but others that I'm pursuing now are. So I don't want to make an assumption that just because they're in a qualified or designated tract now that they could be omitted.
Well, if they're downtown Phoenix, then there's going to be some changes, as you can imagine. A lot's changed since 2010 downtown.
Yeah, thank you.
And Matt, there are maps that you can use to kind of see, not that anything is, or we guys already talked about that? Nothing's been solidified on which ones will be chosen, but you can at least see which ones just wouldn't qualify, just based on.
Right. And there's an event coming up, Matt, April 1st and 2nd at the ACA in Phoenix. You should really plan on attending. I can follow up with you on that.
Robert, I believe you have a question.
Good morning, everyone. Good morning, Angela. This question is, I guess, specifically to Graham, since you're assembling, these multi-layer capital stacks, right? We're doing the same thing here in San Bernardino, but what, I guess, sequencing strategy do you recommend for assembling this, multi-layer stack? So for example, how do you give each capital partner, if you will, confidence to commit when the rest of the stack is still being assembled?
That's a great question, Robert. So what we're working on is often the banks will start to drive this as well, right? Because you got to be able to finance a project. So having a good conversation with your lenders and what they want to see, whether it's LOIs or leases or who's in the general partnership, what sort of commitments or approvals have been made. Putting yourself in a position to have a shovel-ready project, would have a lot to do with that. Certainly showing, market, tenability, having the right market there, having the backing of other incentives is helpful. But you're definitely, most projects need a bank, and they're going to tell you that you're going to have some sort of revenue streams, that you have solidified. So a lot of that comes down to being able to have the right partner to lease your facility or to locate or to rent that facility. Depending on their strength, you may need to bring some additional partners along with that. If, for example, I think you may have mentioned a nonprofit that can be part of that, but they could be backed by a foundation, right? So you may be able to show that there's strength in a deal by having other partners that could even be first loss leaders, through that investment and some other way to show strength of the project in general, and to start to layer that stack to mitigate key risks, and in all ways you can. And Matt's a developer. The number of problems you can see on a project are really limitless. But creating a good foundation with the opportunity fund and the partnerships that you bring is really a key from the get-go.
And I believe we have a question from Patrick.
Thanks, Angela and panel. Great job. Great discussion about some really relevant issues as we're trending to 2.0. To follow up on Robert, though, Graham, on your project, I'm curious. You said you have a JV with a nonprofit. Do they participate in their equity side on the manager or on the manager GP side of the fund, or the QOZB?
We actually have a management entity as well as a QOZB. So we have a separate development company that controls our interest in the QOZB and the QOF. And so we've got a fund manager with the nonprofit, and we act as CCO, Chief Compliance Officer on the project. For some, we're the fund manager as well. But in this case, we're participating together in the economics of the GP and bringing those PRI investors and the OZ investors into that project.
Yeah, and I'm curious, has your nonprofit partner sourced any QOF investors for the project?
This is number one for them. They've done 300 projects in their career, so they've done billions in development, and they approached us about coming together. So that's what's so exciting about this, because it's right in the name. An opportunity zone is a partnership or a corporation designed to make an investment in an opportunity zone. So that it really brings disparate groups together. So here we are, developers in Ohio and a group, that's out of Washington, D.C. coming together to do a deal in Alabama. And so it's really been remarkable, how this works out.
Yeah, congrats on that project, Graham. Full panel, real quick, if I may, Angela. Is anybody seeing any QOFs looking to aggregate 1.0 projects that are in distress prior to the end of the year? Full panel.
You're saying aggregate them for, I'm just curious.
To acquire them,
okay.
either or merge with a QOF, either by merger or an acquisition, somehow take over a project that is in distress.
Like I said earlier, a lot of pref equity, a lot of QOFs coming in creatively into existing QOZBs. And we are seeing, merger activity in that respect.
You may see some refreshing equity being refreshed in a deal,
for example.
Right. Refreshing equity in a deal, and move some projects forward. And so we're seeing that now with some other sponsors that we're working with. So for sure.
Okay, no QOF mergers at this point. Anybody had any experience with that?
Not with an actual merger.
I was gonna say, I do think we have somewhere we have either seen it or are considering it, but not necessarily in the vein that you're suggesting, Patrick. Like that's not necessarily the intention for why they were doing it, but yes.
Okay. Yeah, thank you very much.
A creative idea. Yeah.
I do want to just reiterate that if you have any additional questions, please feel free to reach out to our speakers. I added everyone's email addresses in the chat box, so please feel free to reach out.
Thank you.
Yeah, I think big picture, we're all just very excited for, like I said, the fact that this program has kind of been reinvigorated, that there's new interest, that, hopefully we'll see a lot more success, a lot more projects done because of it. And so, we're happy. Obviously, all of us are happy to help in any way that we can. We've learned by having to fix other people's mistakes that sometimes if you don't have the right professionals helping you on the front end, you have an expensive mess to deal with on the back end. So just if you're interested, just making sure that you're making the right phone calls and getting the right people involved on the front end.
Get a good pro for sure. I would say. Let me echo that.
Well, thank you everyone for joining us and for staying for the whole hour. We really appreciate your time. We'll follow up with the recording of the webinar if you want to reference any of the key discussion points that we covered here. And feel free once again to reach out to our speakers, and we'll be sure to follow up with you.